Listen, if you're holding silver right now, what I'm about to share with you could be the difference between watching your position explode to the upside or getting caught in a trap that wipes out months of gains. And I'm not being dramatic here. The setup we're seeing in silver right now is unlike anything we've witnessed in over a decade. Let me start with something that should make your ears perk up. 3 weeks ago, a major commercial bank quietly closed out the largest short position in silver futures that's been on the books since 2019. Now you might be thinking, so what? Banks close positions all the time. But here's what makes this different. This wasn't a gradual unwind. This was a panic exit. They paid a premium to get out fast, and when I say premium, I'm talking about leaving tens of millions on the table just to close the position immediately. Why would they do that? What do they know that the rest of the market doesn't? Here's where it gets interesting. While that was happening, another group of players was doing something completely different. The mining companies themselves, the actual producers of silver, stopped hedging their future production. Think about that for a second. These are companies whose entire business model depends on managing price risk. They hedge everything. It's like an insurance policy for their revenue. But starting in late October, one by one, they started letting those hedges expire without rolling them forward. I've been tracking precious metals for 17 years, and I can count on one hand the number of times I've seen producers collectively stop hedging like this. Each time, without exception, it preceded a major price move. The last time was in early 2011, right before silver went from $26 to nearly $50 in less than 4 months. Now, let's talk about what's happening in the physical market, because this is where things get really wild. There's a refinery in Switzerland. I won't name them, but they're one of the top 3 silver refiners in the world. They process about 15% of global refined silver. 2 weeks ago, they sent a notice to their regular customers, the big institutional buyers, telling them that delivery times for 1,000-ounce bars were being extended from the usual 4 weeks to 16 weeks. 16 weeks. That's 4 months to get physical silver from one of the world's largest refiners. And here's the kicker. They're not alone. I've confirmed similar delays at facilities in Perth, Australia, and another in the United States. The physical silver market is seizing up, and it's happening quietly, away from the headlines. But the price? The price is just sitting there, barely moving, trading in this tight range like nothing's wrong. That's the disconnect that should have every silver holder paying attention right now. When the physical market is this tight and the paper price isn't reflecting it, something's got to give. And when it does, it's not going to be gradual. Let me take you back to 2008 for a minute, because there's a parallel here that's almost eerie. In September of that year, right after Lehman Brothers collapsed, silver dropped from $14 to $9 in a matter of weeks. Everyone thought it was over. The precious metals bull market was dead. But here's what was happening behind the scenes that most people missed. While the price was cratering, the U.S. Mint couldn't keep Silver Eagles in stock. They were rationing them to dealers. Premiums on physical silver exploded to 30, sometimes 40% over spot price. You had this bizarre situation where you could see silver trading at $9 on your screen, but if you actually wanted to buy a physical coin, you were paying $12 or $13. That disconnect lasted about 6 weeks. Then, in late October, something shifted. The paper price started catching up to the physical reality. By December, silver was back over $13. By January, it was at $16. And by April of 2011, it had more than quintupled from that low. The people who understood what was happening, who saw that disconnect between paper and physical, they positioned themselves during that window, and they made fortunes. We're in a similar window right now, maybe even more extreme. Here's another piece of the puzzle. Industrial demand for silver is at an all-time high. And I'm not talking about traditional uses like photography or silverware. I'm talking about solar panels, electric vehicles, 5G infrastructure, and the big one that nobody's really pricing in yet, artificial intelligence data centers. A single AI data center uses approximately 500 kilograms of silver in its electrical systems and cooling infrastructure. 500 kilograms. That's over 16,000 ounces per facility. And we're not building 1 or 2 of these. Microsoft alone has announced plans for over 50 new data centers in the next 3 years. Google, Amazon, Meta, they're all in an arms race to build AI infrastructure. Do the math. 50 data centers times 500 kilograms each. That's 25,000 kilograms of silver, or about 800,000 ounces, just from one company's expansion plans. Now multiply that across the entire tech sector globally. The Silver Institute estimates that industrial demand for silver will increase by 18% this year alone. That's the fastest growth rate in industrial silver demand since they started tracking it in 1990. And here's the problem. Mine supply is basically flat. We're producing roughly the same amount of silver this year as we did last year and the year before that. So you've got demand accelerating and supply staying constant. Economics 101 tells you what happens next, but the price isn't reflecting it yet. Why? Because the paper market is still in control. The futures market, where most price discovery happens, is dominated by banks and hedge funds trading contracts that represent silver they don't have and will never take delivery of. It's a paper game. But that game only works as long as nobody calls their bluff by demanding physical delivery. And that's exactly what's starting to happen. There's a fund. I can't name them for legal reasons, but they manage about $4 billion in precious metals. In the last 6 weeks, they've taken delivery of 12 million ounces of physical silver from the COMEX. That's 12 million ounces that are now sitting in private vaults, off the market, not available for industrial users or other investors. The COMEX registered inventory, that's the silver that's actually available for delivery, has dropped by 32% since August. We're now at the lowest level of registered silver at the COMEX since 2016. And back in 2016, silver rallied from $14 to $21 in less than 3 months when inventories got this low. But here's what's different this time. Back in 2016, industrial demand was growing at maybe 3 or 4% a year. Now it's growing at 18%. The supply squeeze is happening faster and harder than it did 8 years ago. Now, if you're sitting on silver right now, whether it's physical coins, bars, or shares in a silver ETF, you need to understand something critical about your position. Not all silver exposure is created equal, especially when we're heading into a potential supply crisis. Quick aside here, and this is important if you've got significant retirement savings. If you're sitting on $100,000 or more in a traditional IRA or 401k, there's a way to get physical precious metals into those accounts without triggering taxes or penalties. I put together a free guide that walks through exactly how gold IRAs work, the approved metals you can hold, and the rollover process. It's in the description below. No pressure, but if you're thinking about precious metals as part of your retirement strategy, it's worth understanding how this works. The guide covers everything, completely free. All right, back to what's happening with silver right now and why your position could be at a critical juncture. If you own physical silver, coins or bars in your possession, you're in the strongest position. That's real metal that you control. Nobody can dilute it. Nobody can create more of it with a keystroke. And if this supply situation gets worse, you're holding exactly what everyone else is going to be scrambling to find. But if you own silver through an ETF, you need to understand what you actually own. Most silver ETFs, like SLV, are backed by physical silver held in vaults. But here's the fine print that most people don't read. The fund has the right to settle in cash instead of physical metal under certain circumstances. If we hit a situation where physical silver becomes genuinely scarce, or the premium on physical metal explodes above the paper price, your ETF shares might not track that premium. You could be stuck with the paper price while physical silver is trading 20 or 30% higher. I'm not saying ETFs are bad. They're liquid, they're convenient, and for most market conditions, they work fine. But in a supply crisis, there's a real risk of divergence between paper and physical that could leave ETF holders on the wrong side of the trade. And if you're holding silver mining stocks, that's a different animal entirely. Mining stocks are leveraged plays on the metal price, which means they can amplify gains, but they also come with company-specific risks. Management decisions, production issues, political risk in the countries where they operate. A mine in Mexico or Peru could face nationalization risk. A mine in Nevada could face environmental challenges that shut down production. The point is, if you hold silver, you need to know exactly what you hold and what risks come with it. Because what's coming could expose those differences in a big way. Let me tell you about what happened in palladium in 2020, because it's a perfect case study for what might be about to happen in silver. Palladium is used primarily in catalytic converters for cars. In early 2020, right before the pandemic, there were rumors of supply tightness. Russia produces about 40% of the world's palladium, and there were concerns about export restrictions. The price started climbing. It went from $1,500 an ounce in January to $1,800 by February. Then the pandemic hit, and everyone assumed demand would collapse because car production was shutting down. The price dropped back to $1,600, but here's what the market missed. While car production did drop, the existing supply chains were completely disrupted. Refineries shut down. Shipping routes were chaos. And when car production started ramping back up in late 2020, there was no palladium available. The price went from $1,600 to $3,000 in less than a year. It nearly doubled because the supply chain couldn't respond fast enough to meet demand. Silver is in a similar setup right now. We've got industrial demand accelerating, supply chains that are already stretched thin, and inventories at multi-year lows. The only difference is that silver is a much bigger market than palladium, which means when it moves, it's going to move with a lot more force and a lot more attention. And here's something that should really make you think. Central banks are buying gold at record pace right now. China, Russia, India, Turkey, they're all accumulating gold like there's no tomorrow. In the first 9 months of this year, central banks bought over 800 tons of gold. That's the fastest pace of accumulation since 1967. But silver? Central banks don't hold silver anymore. They sold most of their silver reserves decades ago. So when the monetary system comes under stress, when there's a flight to hard assets, all that institutional money flows into gold. But here's the thing. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting at around 83-1. Historically, that ratio averages somewhere between 50 and 60-1. And during periods of monetary stress, it often compresses to 40 or even 30-1. In 2011, it briefly touched 32-1. If we see that kind of compression again, and gold is sitting at $2,600 an ounce, that would put silver at over $80 an ounce. That's more than triple the current price. And that's not some wild speculation. That's just silver returning to its historical relationship with gold. But here's where it gets even more interesting. The last time we saw a major move in silver, in 2011, it wasn't driven by monetary concerns. It was driven by investment demand. People were buying silver as an inflation hedge, as a store of value. This time, we've got that same investment demand building, but we also have this massive industrial demand component that didn't exist back then. Solar panel installations are up 43% year over year globally. Electric vehicle production is up 31%. 5G infrastructure build-out is accelerating in Asia, Europe, and North America. Every single one of those trends requires silver, lots of it. And unlike gold, which is mostly used for jewelry and investment, silver gets consumed. When you use silver in a solar panel or an electrical contact, it's gone. It's not coming back into the market. That creates a fundamentally different supply-demand dynamic than gold. The World Silver Survey estimates that we're running a supply deficit of over 200 million ounces this year. That means demand exceeds new mine supply by 200 million ounces. That deficit is being filled by above-ground inventories, the stockpiles that have been built up over decades. But those stockpiles are finite, and they're shrinking fast. If industrial demand continues growing at the current pace and mine supply stays flat, we're going to hit a point where there simply isn't enough silver to meet demand at current prices. When that happens, the price has to rise to ration supply. It's not a question of if, it's a question of when and how much. Now, there's another factor that nobody's really talking about yet, but it could be the catalyst that breaks this whole thing open. China. China is the world's largest producer of silver, accounting for about 13% of global mine supply. They're also the largest consumer, using about 20% of global supply for their industrial base. For years, China has been a net exporter of silver. They mine it, refine it, and ship it to the rest of the world. But in the last 6 months, Chinese silver exports have dropped by 47%. They're keeping more of their production at home. Why? Because they need it for their own industrial expansion. They're building solar capacity faster than any country in history. They're electrifying their vehicle fleet. They're rolling out 5G infrastructure to every corner of the country. If China goes from being a net exporter to a net importer of silver, that's a game changer for the global market. That's millions of ounces that suddenly aren't available to the rest of the world. And there's no other country that can make up that supply gap quickly. I've been watching Chinese silver flows very closely, and the trend is unmistakable. They're hoarding silver. Not for investment purposes, but because they need it for their strategic industries. And if you're a Western manufacturer who depends on silver for your products, that should terrify you. Because when supply gets tight, China isn't going to prioritize exports. They're going to prioritize their own industries, which means the rest of the world is going to be fighting over a shrinking pool of available silver. This is the setup. This is why your position in silver right now could make or break your portfolio over the next 12 to 18 months. If you're holding silver and you understand what's happening, you're positioned for what could be one of the most significant moves in precious metals we've seen in a generation. But if you're holding silver and you don't understand the risks, if you're in the wrong type of exposure, or if you're not prepared for the volatility that's coming, you could get shaken out right before the big move. Let me tell you what I think happens next, based on everything I'm seeing. In the short term, the next few weeks to maybe 2 months, I think we're going to see continued volatility. The paper market is still in control, and the banks that are short silver are going to fight to keep the price suppressed as long as they can. They'll use every tool they have, selling into rallies, spreading negative sentiment, pointing to any economic weakness as a reason silver should go down. But underneath that surface volatility, the physical market is going to keep tightening. Delivery delays are going to get longer. Premiums on physical metal are going to start widening. Industrial users are going to start getting nervous about securing supply, and they're going to start placing larger orders further in advance. At some point, probably in the first or second quarter of next year, something's going to break. Maybe it's a major industrial user who can't get the silver they need and has to shut down production. Maybe it's a refinery that defaults on delivery commitments. Maybe it's a large fund that demands physical delivery from the COMEX and exposes how little silver is actually available. Whatever the catalyst is, when it happens, the price is going to gap up. Not gradually climb, but gap. We could see silver jump $3, $4, $5 in a single day. And once that happens, once the market realizes that physical silver is genuinely scarce, you're going to see a rush for the exits by everyone who's short. That's when the real move begins. That's when silver could go from $30 to $40, then $50, then higher. Alert. If you hold silver, this could make or break your position. Listen, something extraordinary is happening in the silver market right now. And if you're holding physical silver or silver positions, you need to understand what's unfolding. Because the next few months could determine whether you're positioned for massive gains or left watching from the sidelines. I'm going to walk you through exactly what's happening, why it matters, and what you need to know to protect your position. Let me start with something that should make every silver holder sit up and pay attention. In the last 6 weeks, we've seen industrial silver demand hit levels we haven't witnessed since the solar boom of 2021. But here's what's different this time. Back in 2021, it was primarily solar panels driving demand. Today, we're looking at a perfect storm of industrial consumption that's creating supply tensions unlike anything we've seen in decades. The numbers tell a story that most people aren't paying attention to. Global silver mine production has been essentially flat for the past 3 years, hovering around 830 million ounces annually. Meanwhile, total silver demand, when you combine industrial use, jewelry, silverware, photography, and investment demand, has been running at about 1.1 billion ounces per year. You don't need to be a mathematician to see the problem here. We're consuming roughly 270 million more ounces than we're mining every single year. Now, you might be thinking, well, that deficit has to be filled from somewhere, right? And you'd be correct. It's being filled from above-ground stockpiles, from recycling, and from existing inventories. But here's where the story gets really interesting, and why your position in silver could be at a critical juncture. The COMEX silver inventories, which are the registered stocks available for delivery against futures contracts, have been on a roller coaster. We saw them peak at around 400 million ounces back in 2021. Today, we're sitting at roughly 280 million ounces in total COMEX stocks, with only about 75 million ounces in the registered category, the silver that's actually available for immediate delivery. That's a 43% decline in just over 3 years. But the real story isn't just about the total numbers. It's about the velocity of withdrawals and the pattern of what's happening. In the past 18 months, we've seen repeated episodes where large quantities of silver have moved from registered to eligible status, meaning it's no longer available for delivery. We've also seen significant physical withdrawals from the COMEX warehouses entirely. Let me paint you a picture of what this looks like on the ground. Imagine you're a major industrial consumer. Let's say you're a solar panel manufacturer in Germany or a semiconductor producer in Taiwan. Your production lines require a steady stream of silver. It's not optional. Without silver, your production stops. Now, you've been buying silver on the futures market, taking delivery when needed, and everything's been running smoothly for years. But starting in late 2023, something changed. Your procurement team starts noticing that premiums for physical silver are rising. Not dramatically at first, just a few cents here and there. Then you notice delivery times are extending. What used to take 2 weeks now takes 4. Your suppliers are telling you there are logistics issues, refining bottlenecks, transportation delays. You start hearing whispers from other manufacturers facing the same challenges. So what do? You start building inventory. You start taking delivery earlier. You start securing supply contracts further out. And when thousands of industrial consumers around the world start doing the same thing simultaneously, you create a self-reinforcing cycle of physical demand that puts enormous pressure on available supply. This is exactly what we're seeing play out right now in the silver market. The industrial users are getting nervous, and when industrial users get nervous, they don't wait for prices to come down. They secure supply at whatever price is necessary because the cost of silver in their final product is minimal compared to the cost of shutting down production lines. Let's talk about the specific industrial drivers that are creating this unprecedented demand environment. Solar panels are the obvious one, and the numbers here are staggering. Each gigawatt of solar panel production requires approximately 1 million ounces of silver. Global solar installations are projected to reach 500 gigawatts in 2025, up from about 350 gigawatts in 2023. That's an additional 150 million ounces of silver demand just from the growth in solar. But solar is just the beginning. Electric vehicles are consuming silver at an accelerating rate. The average electric vehicle uses about twice as much silver as a traditional internal combustion engine vehicle, roughly 25 to 50 grams per vehicle, depending on the model. With EV production expected to hit 20 million units in 2025, up from 14 million in 2023, that's another significant chunk of incremental demand. Then you have 5G infrastructure build-out, which is silver-intensive. Every 5G base station requires substantially more silver than 4G infrastructure. With countries around the world racing to deploy 5G networks, and now early discussions of 6G beginning, this represents a multi-year demand driver that's just getting started. The electronics sector broadly is consuming more silver as devices become more sophisticated. Artificial intelligence hardware, data centers, advanced computing systems, all of these require silver for their electrical conductivity properties. As AI deployment accelerates, and we're seeing massive capital expenditure in this area from every major tech company, silver demand from this sector is growing exponentially. Now, here's where it gets really interesting for anyone holding silver positions. While all of this industrial demand is surging, we're simultaneously seeing a resurgence in investment demand. And this is where the dynamics could shift dramatically in favor of silver holders. Let me take you back to 2011 for a moment, because there are some eerie parallels to what we're seeing today. In 2011, silver hit nearly $50 an ounce. What drove that move? It was a combination of factors. You had concerns about currency debasement following the 2008 financial crisis. You had massive quantitative easing programs from central banks. You had geopolitical tensions. And you had a surge of retail investment demand as people looked for alternatives to traditional financial assets. The move from $18 in late 2010 to $49 in April 2011 happened in just 5 months. It was explosive, it was volatile, and it caught most people by surprise. Then came the crash, and silver fell all the way back to $26 by the end of 2011, eventually bottoming around $14 in 2020. But here's what's different today compared to 2011. Back then, the industrial demand story was present, but not nearly as compelling as it is now. The solar industry was in its infancy. Electric vehicles were barely a factor. 5G didn't exist. The industrial demand base for silver today is fundamentally stronger and more diverse than it was in 2011. At the same time, the investment case for silver is arguably more compelling now than it was then. In 2011, we were dealing with the aftermath of one financial crisis. Today, we're dealing with the accumulated effects of over a decade of unprecedented monetary expansion, massive government debt levels that dwarf what we saw in 2011, and a geopolitical environment that's arguably more unstable. Central banks around the world have been buying gold at record levels, but silver has been largely ignored by official sector buyers. This creates an interesting dynamic. As gold prices rise, driven partly by central bank buying, the gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been fluctuating in a range that historically suggests silver is undervalued relative to gold. Right now, that ratio is sitting around 88 to 1. Historically, the average has been closer to 60 to 1, and during periods of precious metals bull markets, we've seen it compress to 40 to 1, or even lower. In 2011, at the peak of the silver rally, the ratio briefly touched 32 to 1. If we were to see a similar compression today, with gold at current levels around $2,650, that would imply a silver price north of $80 an ounce. Now, I'm not making predictions here, but I am pointing out the mathematical possibilities based on historical precedent. The point is, if you're holding silver, you're holding an asset that has significant upside potential based on multiple converging factors, both industrial and monetary. But here's the critical question, and this is what could make or break your position. Are you positioned correctly for what's coming? Because there's a big difference between holding silver and holding the right kind of silver in the right way.